Welcome to the 2026 Annual Investment Meeting. My name is Kelly Duncan. I'm the President and CEO of Colorado Gives Foundation. Today, we're really excited to be with you because it is our way of saying thank you. Thank you for letting us be a part of your philanthropy. Thank you for entrusting us to do good work with you to have community impact. We have 3 goals for today. The first is to look back on 2025. How did the markets do, and what did that mean for your funds and the work you're doing in community? Second, Robert's going to pull out that crystal ball and look ahead. What's going to happen in 2026? What will that mean for your funds and for the work that you're doing in the community? And finally, we have some inspiration and education because we're invested in your good work, not just financially, but also about impact. So you'll get to hear about AI and what it might mean for the future of nonprofits and philanthropy and the community writ large. So we're excited to be with you because we care about impact. Colorado Gives Foundation is a community foundation. And as I said, our mission is to connect people, ideas, and nonprofits to make good happen. And we do that at 2 levels. We work in Jefferson County, where we partner with nonprofits and individuals who are aligned with our vision that all of Jeffco is thriving. And we're really humbled that we get to contribute $7 to $10 million a year toward that vision. We also work statewide. And statewide, we work to build the capacity of nonprofits and donors. We do that with donor advised funds. So if you are a donor advised fund holder in the room, thank you. You contributed, our donor advised fund holders, $7 million into nonprofits in 2025. It's a whole lot of good that's happening in community. We also steward nonprofit endowments. So if you are an endowment partner, thank you. With your endowment, we could invest $2 million in current operations of those endowment partners while we were simultaneously investing in your long-term future to continue to contribute to the community. And we also run the online giving website, coloradogives.org, that we use annually for Colorado Gives Day. So if you were a donor on Colorado Gives Day, please raise your hand. Look at that. Thank you. We had over 103,000 donors participate in Colorado Gives Day this year, and they donated $56.6 million to support Colorado nonprofits. I am awed every year at the generosity of donors in Colorado and at the resiliency of the nonprofits who make Colorado Gives Day happen. Thank you all very much. And it's never too early to mark your calendars. December 8th is this year's Colorado Gives Day. And so now it is my pleasure to introduce you to Kelly Kaminskis. Kelly Kaminskis has over 2 decades in the banking and financial industry, and she is well known for digital prowess and innovation. But Kelly's not just really good at what she does professionally, she also has a heart for the community. And she's been serving on our board since 2021. She currently serves on our executive committee, and she's chairing our finance and investment committee. And when she's not working or giving back to the community, she lives in Golden with her husband and 2 kids, and I hear she spends a lot of time watching youth sports. But she reports that her favorite day of the year is Colorado Gives Day. So please join me in welcoming Kelly Kaminskis.
Boy, that was a much more generous introduction than I've ever received. Thank you, everyone. I just want to echo Kelly's comments. We're so glad that you're joining us here today. And she is right, Colorado Gives Day, my #1 favorite day of the year. The investment meeting is actually my 2nd favorite day of the year. So I'm so glad that you're here with us today. As Kelly mentioned, I serve as the chair of the Finance and Investment Committee, taken over from Dale Martin, who has done such a good job with the committee in past. A lot of my fellow committee members here, we also get the pleasure of working with the foundation staff, who is truly talented and committed to the mission of Colorado Gives. We do really exciting things like set the budget, make sure we remain accountable to the budget, and oversee our investment advisors as well. So with that, I'm going to introduce us to our investment advisor. We have the pleasure of working with Graystone Consulting, a division of Morgan Stanley. They have over $600 billion in assets under management. As part of my role as COO of First Bank, and I'm sure as many of you, overseeing the balance sheet, important role of what you do, but it's one of many hats that you wear. So it's important that we connect with true advisors in this arena and true talent. And we have the pleasure of working with Robert Morris, an executive director at Graystone. He has worked there for over 2 decades as well. And he is both entertaining as well as just being able to speak to us as real people about what is going on in the markets. We also always happen to have this meeting in line with major global events and sometimes weather events. I think this is our 2nd year in a row where we've had a major weather event as well. So without further ado, I'd like to turn it over to Robert.
I would just echo the comments as well that Kelly just mentioned. Today is actually my favorite day of the year. Coming back to see so many familiar faces, some new faces I see in the crowd as well. And hopefully what we're going to do today, and again, unfortunately, major geopolitical events are taking place. I wish this was one of those nice quiet years where we could just say, yep, everything was fine and we expect the next year to be fine as well. But one of the critical adages that we always like to say in finance is the markets do climb a wall of worry. So take at least comfort in that factor and also take some comfort in the long-term nature of the funds that we have invested here and that long-term work that the foundation's doing. That will serve you better than kind of worrying about some of the short-term events. But it is my job here today to kind of go over some of what took place last year. And I always love this type of meeting as well because it gives us the ability to almost fact check what we were telling some of you last year that you'll remember. So up on screen here, and I promise I won't belabor too many of the slides, we'll kind of keep this conversational. And exactly as we said earlier, we do expect there to be a lot of questions given what's going on. So please don't hesitate to use those cue cards that we've handed out as well. So global stocks last year, as measured by the MSCI All Country World, gained 22.3%. That puts last year in the upper echelon of many of the years of market history. The US was no slouch as well, gaining almost 18% for the S&P 500. And in actual fact, small cap securities, as measured by the Russell 2000 and the S&P 600, they were positive, but they were among some of the laggards last year. And we'll go into the reason for that and possibly one of the reasons that we see in this coming year, 2026, the balance of this year, where they could actually work fairly well for portfolios. International stocks, by far and away, were the best performing asset category. And you know, it's kind of rare that I get to say that because I can remember it's basically been about 10 years since international stocks have really done something positive or strong or outperformed the US markets. But look at that, a staggering from the EFI, the Europe, Asia, and Far East Index, 31.2% gain. The dollar did decline last year. If you measure that same gain in local currency, taking out the impact of the dollar decline, 21.2%. Still a very strong figure. We are also going to touch on, there's one glaringly gold-colored item that's on the page there, the 64% move in gold. And then obviously, last but not least, the bond market, also positive, which was very helpful for running balanced and diversified programs, such that we do with the foundation here. 7.3% for the Barclays Ag. Not a bad year, but unfortunately, as you can kind of see on the page, it's one of the lower numbers on the page, even though it was a positive return. So this time last year, when we were speaking together, we were just about to go through some of the throes of the tariff confusion. And I bring this up again in today's meeting because we do believe that the past could kind of be prologue to some of the confusion that we're actually seeing in the markets today. And obviously, even some of that still related to the tariff program. So please note, last year, incredibly high volatility. We actually had if I use my laser pointer here, about an 18% contraction to the markets right after we were speaking, despite the fact that at that time we were projecting a positive market. Same could be true for this year. So we declined 18% before rallying back, closing almost that 17.5% figure that you saw. The tariff situation last year was resolved in time. Companies were actually able to adjust to what was going on. Now, initially when they were announced, there was a lot of just fear and confusion. Companies were saying, where am I going to get my supply from? Am I going to be able to buy this piece from China? We knew one electronic manufacturer that was literally ready to send out an email that he'd written over the weekend, basically explaining to all of his staff that they were going to be out of business on Monday because the economics had changed that much. So that was the level of intense confusion. No wonder we were down 18%. Then we started to get economies, other central banks and so forth came to the table. We got some things figured out. And this is the important part. It was not long enough for the rot to set in. And what I mean by that is if you stay in a fearful or confused mode for too long, the natural reaction is just, well, I'm not going to spend, or I'm going to cancel that big project that I had. You know, that data center that I was going to build? Maybe let's do that next year instead. Let's stop and assess. So whenever the markets go through these moments of confusion, and the whole geopolitical scenario that we have unfolding today, and in particular what we're seeing in the oil markets, would dovetail into one of those time horizon moments. If we kind of get through this in a week or two, it'll be an entirely different picture than if this sets in for 3 or 4 months. At that point, I could see firms like ours changing some of our forecasts if some of this sets in longer. So last year, diversification it truly helped. And in actual fact, one of the things that we call out here, just to illustrate this point further, the average return of the last, from 22 to 24, make my point again on the international side. Developed international stocks, the average return over those last 3 years, basically 2% annualized. Very lackluster, and then all of a sudden, 33%. Emerging markets would be the same, -1, all of a sudden 34%. So that clearly started to help with the diversification picture. I'll call your attention here as well, over on the right-hand side of the page. Very interesting, obviously, to be talking oil and the US dollar. So today, one of the things that we're seeing is, of course, oil is now getting what we call a security premium, is the fancy term for it. The security premium is the confusion around the price, and obviously all of the action that we're seeing in the Strait of Hormuz today. So actually, before coming into the meeting, when we last checked the futures, $85 a barrel. So clearly, there's been some highlighted premium that's basically been put into there. That also impacts the US dollar. So last year, we had US dollar broadly declining, and we think it still will for the balance of this year, and I'll go into the reasons for that in more detail. But as we sit here today, believe it or not, we are one of the largest oil producing and exporting nations. So because of that, we're actually seeing the US dollar is catching a bid. It's actually being driven higher. It's rallied about 5% kind of throughout some of this, the events over the past week. But again, I'll go back to my earlier point, the time horizon for how long that stays in is really what's going to matter. So projections for this coming year, and I'll justify and kind of explain where we think things are going. But the big tagline for today would be our U.S. market forecast would be 7,500 to 7,800 on the S&P. So that's obviously a lot higher than where we are today. We closed last year at about 6,850. So we do see this as a year where we can actually have expansion. And I'll explain a couple of the things going on behind the scenes. So this is where I'd like to say we're cautiously optimistic as a firm. So drawing your attention on the right-hand side, ultimately, and I keep coming back to this in meetings like this because it's so fundamental, stocks move based upon their earnings and the price that people pay. So when we look at the price to earnings ratio or price divided by earnings, that's kind of the litmus test that we always come back to when we're making forecasts like this. So let's check in on company earnings. So the consensus across most of Wall Street is for earnings to actually grow this year. 15% is the consensus, and our firm's a little bit more optimistic. We're saying 17%. Now, I do appreciate that we're kind of in early March, so I get the benefit of one nice piece of hindsight here. We've already had some of the first quarter earning announcements and so forth. About 14 and change percent was the average growth rate. So this is already starting to come to fruition. And then, what are people going to pay for those stocks? Now, I do describe this next part, and Ken's heard me say this in investment committee meetings. This part of the forecast is kind of like the chocolate cake of the forecast. You can eat chocolate cake maybe once for lunch. You can't necessarily do it for breakfast, lunch, and dinner, even though it tastes good when you're doing it. We're at elevated valuations. We know the market is robustly valued. But there's also not necessarily a catalyst for that to change or go back the other way for several critical reasons. Point number one, we are printing, again, more money as a nation. We use the term M2 money supply. You can chart and check this, but it's actually growing. So if we're printing more money, that's basically propping prices up. Also, the other thing to consider is price to earnings levels are always relative. They're relative to the risk-free rate in the economy. That is the rate of the federal funds. So basically, if you have lower rates, well, that means people will pay more for stocks because you can actually earn more from a stock than you can a bond at that time period. I'm simplifying things a little bit here, but it kind of makes the illustration. So if we would say that the fair value of the market today should be around 18 times, we're accepting the fact that we're probably not going to see valuations come down this year. They should stay elevated. And here's two other critical items as to why this will take place. We are in a mid-cycle part of the expansion. It's also, and I promise I stay apolitical in these discussions, it's also midterm election year too. We have some stimulus measures that will be coming through. Obviously, you've got the hangover of last year's, quote, big beautiful bill, which should lead to some tax cuts in areas that you're going to see those basically hit checking accounts about this time. So that is actually going to be stimulative for the economy. The other thing that we're seeing is that last year, remember we were talking about the growth of the Magnificent Seven, all of the AI companies. We're going to have a wonderful presentation on the usage cases of AI coming up. All of those companies are now earning and spending that in other areas of the economy. So we are going to see a pick up for some of the other, 493 companies, as it were. So while I'm here actually on this page, because I know we're probably going to get asked this question coming up, inflation readings. It is higher than we would like. 2.8 to 3, historical average is kind of more like a 2 to 2.5. Literally, energy prices are a big component of that. Anything that we do, anywhere we travel, any good that we move to the grocery store even, energy is used to do that. So it's kind of a base level. If energy prices are higher and they are sustained higher, yes, you could see inflationary pressures. And please remember, the Fed has a dual mandate, 2 jobs, full employment and stable prices. So right now, the concern has been stable prices, because elevated inflation levels, does the Fed need to push them down a little bit further? And in which case, that would mean don't try to accidentally overheat the economy, and that stayed the hand of Powell previously, and it's going to be a data point that Walsh, the new Fed chair, is going to have to look at very closely. His other job, of course, is employment, and we're going to touch on that in some of the slides later on, Today, this morning, before coming in, we actually had a negative jobs report. So now, again, I would say the worst job possibly in the world would be Fed chair. I don't know why anyone would fight to get that job. But now you have a new data point that you're looking at that would say, oh, maybe I don't, maybe I do need to cut because of the employment figures, but I don't because of the inflation figures. So they're kind of getting stuck between the rock and the hard place here. So obviously what's taking place with energy, to my earlier comment, if the Middle East situation is shorter lived in nature, you're going to see less of a damage show up in the inflation figures. If it stays in for longer, this is one of those kind of like the rot starts to set in, that's where you'd have to reassess basically, and you could see higher inflation. So let's just kind of for my next trick, basically, I'll accurately predict the weather for us coming up. But I did just, want to put this in here briefly here because our price target for the end of last year was 6,800. And that was looking lofty and optimistic right when we were going through the throes of the tariff. We closed the year at 6,846. We're in good company this year. A lot of firms are actually seeing what we're seeing as far as the expansion. If you took our high-end forecast, that would actually be a very decent year again for the US equity markets. And truly, if you look at business cash flow, spending, and so forth, you can see there are those positive underpinnings. It's just kind of getting out of the way of some of these news cycles that we have developing before us. So one of the critical things, though, about the last couple of years, and this is going to start to shift into what we see going forward then for 2026, one of the critical things is we have been on one note, essentially. The Magnificent Seven, since the October lows of 2022, showed a 215% earnings growth, a 75% multiple expansion, and then last but not least, a little bit of dividends, for a almost 300% rate of return. It's almost about 100% annualized over that time period. That is definitely not normal. That would be the exception to the rule. What is more normal is they get forgotten, but it's the S&P 493, the other companies in the market. Normal earnings, 34%, 36 on price multiple expansion, 74%. So this is the norm, not this. It's been nice to have, but that's led us to one critical worry point in the markets, and one that we're often asked about is the concentration that we now see. I was talking about this last year with everyone here too. I'll kind of call out that last year would have been about here. Yes, record concentration. Guess what? Even more record concentration this year. So one of the critical questions is, well, if there is a misstep with one of these companies, can that take down the whole S&P 500? Or what do we need to maybe look at differently in terms of the investing mix, particularly when it comes to US large cap stocks? Because a lot of people are starting to draw those parallels between 98 and 99. And in fact, that's actually when you can see that last level of extreme concentration, which by the way, wasn't even the 30% level, now 40.7 times. That is also where we see the highest valuations. So remember I said earlier that 22 times was the market average. Well, actually the other, the equal weighted index, if you take out the impact of the NVIDIAs and the Googles and so forth that are pulling that up, you actually see a more normal 17.6 times. The Magnificent Seven are pulling that up to 28.7 times. So, just to point out that our US markets have become dominated by one particular trade. So, to answer that next question, and we're going to spend a little bit of time here on this page, to answer that next question, what would happen to the Magnificent Seven basically for this year, this coming year? And you're already starting to see some of this play out. Couple of quick data points. If the markets are up approximately 17%, would you believe that 4 out of the Mag 7, 4 out of 7, underperformed the S&P 500? it was actually only 3, Google, NVIDIA, and Tesla, that actually did better than the overall market. So point number 1, yes, you can see leadership change and rotation among these companies, and it doesn't necessarily have to take down the whole market. In fact, last year was already one that we lived through in that mode. So here's another thing to think about, though, with these companies. All of these companies used to have, from the 2010s to 2020, they used to have what we call economic moats, big defensive rings around them. Who would dare charge Amazon in web services? Who would dare go up against Tesla in self-driving cars, for example? These companies did not compete with each other. In fact, they would often just work together on various projects. Now we've entered a different time in the world. I'm going to call out a couple of key events here for us. Tesla, obviously now they're getting into the data center and communication business. They have, on the private side, obviously, Grok, XAI. You've got NVIDIA, which actually developed, I chuckle at this one, that I would never have thought these two companies would have competed. They developed self-driving car software, and they've sold it to Mercedes, Ford, and GM. So now you have NVIDIA competing directly with Tesla. You've got Google saying, I'm maybe a bit concerned about the chip capacity that NVIDIA has to churn out. So I'm going to make my own chips instead. So you've got Google actually going into the chip manufacture business. So the competition among these companies has absolutely heated up, and it's heated up to an incredible degree that it is actually going to shape what we see for the full balance of this year. The other thing that we talk about with these firms, each of them are involved in one step or another in the AI build-out. We've gotten to a point where the technologies, and many of them are private still, obviously, ChatGPT, XAI, but a lot of these companies do have significant ownership or investment in those. And they're kind of involved in that ecosystem. By the way, if there was a Magnificent Seven in the public markets, there's one in the private markets as well too, and we'll touch on that coming up. But each of these firms kind of has their own horse that they're backing in this race. And there's about 5 of them. So if we talk about, Anthropic, Gemini, ChatGPT, Grok, all of the different models, they've hit a level that is actually fit for purpose. It works. You can use it. You can use the agents. There is productivity gains. That can actually be demonstrated. We're all using one form or another. I would say it's probably specialist work to try to tell the difference between, say, a GPT-5 or a Gemini. They're all essentially fit for purpose to some level. So these companies now are actually engaged in an arms race, if you will, because they want their model that's being backed to be the ultimate one that we use. As a quick show of hands in the room here, who is using an Apple phone today? Okay, wow, that's actually more than I thought. Statistically, it should be about 60 to 70%. That's a lot. Hands up who's using a Samsung device. Okay, there's the rest. Hands up who's using a Nokia. Oh, nobody. Who's using Research in Motion, a BlackBerry? Who's using anything else that I haven't said there? Okay, excellent. What is it? I'm just curious now. Oh, Motorola. Motorola would be another one there. Yeah? No? Google, okay, excellent. Okay, that was a good illustration because obviously back in the year 2000 when we had the telecom revolution and putting devices into our pockets for the first time, there were 5 major players. And ultimately, what happens in a competitive industry, those eventually narrow down. So we are seeing competition, obviously, from who's going to be using Anthropic, not the government, who's going to be using ChatGPT, whose systems are they going to build on. And when you're running a large Fortune 500 company, about the worst nightmare that you could wish on one of your enemies would be going through a software conversion. You never want to do it. So these companies recognize that there's a first mover advantage. They want to get in to the company first. They want to get ingrained into the systems. There's a switching cost. So you never want to go through that again or pay billions of dollars twice. So if every AI model currently is, we'll call it fit for purpose, it works, does what we want, how are these companies going to compete? They're going to do it on price. That's the good old-fashioned way to do it. You want to be cheapest first. And the way that we measure price in the AI world is a cost of a token, the usage. So how do you get your token costs lower? More and more data centers. This is why everyone is talking about building data centers together. And I will stagger you here with a couple of numbers because we have the benefit of already seeing now some of those first quarter earnings. And it's so telling for what's going on. I'm going to pick on Microsoft first. There's Microsoft. They announced very proudly a 20% revenue growth. That's fantastic. And they also announced 180 billion worth of spend. The stock actually moved lower after the earnings announcement. Even though it was very good, the zeitgeist has now switched to, oh, you made all this cash, but you just used it all. So are you really generating free cash? Interesting. I'm going to now pick on Google down there. Similar growth rate, but guess what their spend was? 200 billion. So just in those two companies alone, we've basically got almost 400 billion worth of spend. The actual figure, now we have the benefit of hindsight, we can kind of sum this up, for the first quarter was just shy of $1 trillion. That is the planned, going out, data center construction, chips that's required into that. It's a huge level. And I'm going to help try to put that into perspective here today for us all. So one perspective, and I won't ask a raise of hands on this one, but I will on my next. If you sum what we spent on the moon landing, the Manhattan Project, and the interstate highway system, that is less than the spend that we just had announced at the beginning of this year. In fact, now, because trillions of dollars is such a huge figure, very difficult to get your arms around, we're actually going to shift gears and measure that as a percent of GDP. That's the other way that we look at these items. There is only one spend in the history of the United States that is actually higher than what we're doing now. Can anyone hazard a guess what that spend was? Yes, go ahead. No, good. Yes. I appreciate that answer. I'm going to shift it to a spend in something that we did. A good. Yeah. Healthcare. That's a great one. But no. It was actually 1803, the Louisiana Purchase. That was 3% of GDP, and this is coming up to about 2 and change, 2.5 almost. So, and it may actually get there, by the way. But all of that spend has got to go somewhere, and this is the answer to why. Do you know what one of the top performing stocks is year to date? It's actually Caterpillar. Surprising, isn't it? Yellow earth moving equipment. Guess what? Because all of these companies are now spending on those data centers, and they actually need them to be created too in order for this to all work or all pan out. One item that I do find absolutely hilarious, though, and we put this in for almost a little bit of a laugh line here for this. So we're talking about huge performance figures. We're talking about robots, self-driving cars. We're talking about AI. We're talking about space programs, both of which were outperformed by two. Oh, I think I've lost battery, maybe. I could project. Both of which were outperformed by 2 rocks last year, gold and silver. So that actually does go to tell you that there is a concern as to whether this, thank you. There is a concern as to whether this, the spend rate will actually be justified and can continue, because so much of our future has now basically been banked on this. Okay, so a couple of surprises. One other surprise on last year that we'd mention. Within the emerging market regions, there's a topic, and I'm sure we'll probably get questions as well on this later. What is going on with manufacturing? Nearshoring versus onshoring, you hear those type of terms. because we went through such a global reorganization of the entire trade patterns. That was one of the fallouts of the tariff discussion that we saw earlier. And I would not have had this on a bingo card for 2025. So I would firmly put this into a surprise. Some of the best performing areas were actually Latin America, Mexico, and Brazil. But those were the economies that actually seemed to work alongside our administration versus fighting some of the tariff moves. So very much so, we saw manufacturing that was taking place in, say, China or India. I think, yeah, India is the worst performing one there. Surprising. We actually saw a lot of that manufacturing move back to nearshoring, or in some cases onshoring, which, by the way, that should work well for those small and mid-cap companies that we were talking about earlier. The other anomaly that we saw last year, and again, this is now kind of shifting gears to the, do we have a worry like, the 99-2000 style era. Small and mid-cap securities, there was something else that was going on underneath the hood there. We actually had companies with negative earnings rallying 60% from the lows. I haven't been able to find a way to make a business work without any earnings over the past 20 odd years. I don't think ultimately it happens or can take place. But last year, there were a lot of companies where literally, if you just put AI after its name, I'll call out a few: Airship AI, Big Bear AI, some of which, God bless, they're trying to get contracts and so forth. But the issue is they don't have any earnings. But that was valued so richly by the market last year. And we had a whole swath of companies that did have earnings growth that just simply didn't move. We think 2026 is the year where that starts to shift. We've already seen the first green shoots of that basically taking place in the first quarter. And in actual fact, to my point earlier, those mega cap companies that have announced the 180 billion, the 200 billion worth of spend, that has to go somewhere. It's going to companies that either do construction, power, water, cooling for the data centers and so forth. That is causing a boost to take place with all of the small cap company earnings, so much so that they're higher than the large cap cousins. So one of the answers to the earlier question that was posed is, can the Mag 7 performance, if they go negative, will that take down the overall S&P 500? We don't think so, because there's so much activity that's happening now with the other 493 companies. Those are all starting to do really, really well for us at this point. There's so much to talk about this year. You've got the copies of the presentation and so forth, and hopefully be able to look back on parts of the video. But there are some other controversies to talk about. Two of which on the AI side, and I'll just address those up front before we go into some of the other areas. One of which is the AI adoption happening fast enough? Because Jensen Huang of NVIDIA, even on his earnings calls, he announced by 2029, we're going to see a majority of Fortune 500 companies that will have adopted and be using some form of AI. I work for a Fortune 500 company, and it's so frustrating how slow we can be at times. So it's no surprise, and some of you I see are smiling in the room here, 15 to 20% is where the adoption is right now. According to Jensen's math, we should be about 25. So we are slower than projected to bring these things online. The other item is, are we going to have enough data center throughput? Yes, all of these projects are being announced. 5 miles square in Texas, outside of Abilene. Literally 5 miles one way, 5 miles the other way. Massive data center. It's gotten to the point, though, where state and local governments are starting to say, hang on, do I really want that in my backyard? Am I going to be worried about energy costs? Is it going to take all the water of the area? So planning permissions have gotten harder. And in fact, in talking to a lot of state and local government officials, even if everyone wanted it. About 18 months is about as quick as you could get one approved and shovel ready at this point, which is one of the key reasons, by the way, why Elon wants to shoot these things into space. No planning permission there. So that is a risk to the AI outlook. And as I've already illustrated, there's so much kind of future that's banked on this. These would be the items to watch for in 2026. I'm going to talk about, and I can make fun of economists here because, I am one. That was my, education was actually in that, and it's a social science, by the way. And jokingly, I'd say at the beginning of any presentation like this, there are those that know what's going to happen, those that don't know what's going to happen next year, and those that don't know that they don't know what's going to happen next year. Mid-cycle economy. Are we early or late cycle? Literally, economists don't know right now. It's almost as if you've been on a car journey, you fell asleep through half of it, you don't know if you're 2/3 of the way there or only 1/4 of the way there. We might have even had stealth recessions in other industries already. The consumer has been kind of lackluster over the past 18 months or so. That hasn't really driven any other part of the economy. So the big question is, and again, thankfully above my pay grade, and now Walsh & Co. will have to sort that out, are we mid or late cycle? Do we need any more stimulus? Or did we already accidentally give stimulus on top of an already robust economy? The other thing that we list as a surprise here would be the K-shaped economy. And this is a tough one to talk about, as there's a very real human component to this. And I always like to try to separate the economic numbers, the data. Dale and I like to say just the facts, when we report this. But there is a disconnect between what's been going on in Wall Street, the AI economy, and Main Street. Which is why if you just kind of walk around in general, you'll feel that the zeitgeist is, it's okay. 2025, it was a fine year, I guess. Most small businesses would kind of act like that or tell you that. They're not going gangbusters and saying, oh, you'll never guess what we did. We deployed this AI system. It was great. My productivity went up and we made so much money last year. That is not necessarily being reported. But you have this gap that's developing. The folks that own assets, have a house price that's still been appreciating, that have owned NVIDIA stock, for example. Well, yeah, they're the top portion of the K versus the lower portion of the K, which is just hanging on. As one aside, and I think I have a little bit of data on this later, the wage growth last year was roughly, call it 4%, and as you saw, inflation was kind of in the mid to high 3s. So technically, Main Street made a little bit of headway last year, but it doesn't feel as robust as it should. There's one other item on here, which is a funny one to talk about, credit cockroaches. Love that terminology. Also, isn't it fun when billionaires get on the news and fight each other? That's literally what we had. We had Jamie Dimon from JP Morgan and a guy called Mark Lipschitz from Blue Owl. So Blue Owl is a private credit company. Private credit is literally just making your own private loans. It's non-bank lending, and it's not publicly traded. There's a jolly good reason for it to happen. The easiest illustration is, imagine if you've got 4 people that own a business together, one wants to retire, well, the other 3 want to keep the business, they don't want to bring on another partner? Yeah, sure. We could go talk to a private credit firm and we can borrow money to buy out our other partner. Then the private credit firm just has a loan with a good quality firm. Fantastic. It actually works as a business model. But the risk that we're seeing is always, and this happens in Wall Street all the time, too much of a good thing. There is the potential for a lot of other lending taking place, especially, by the way, with those big data center build-outs. I'm going to show you in a moment, not only are those free cash flow generating monster companies, not only are they using all of their cash, but they're actually borrowing as well to do more. That's how much importance they place on leapfrogging their competitors and getting to that cheapest token. We have already seen a few blow-ups in private credit. Nowhere near the level of, like a 2008, 2009, but that is one of the items that you're going to see talked about on the news media, and something that we pay very close attention to with the Colorado Gives portfolios as well. Fortunately, we're not exposed in those areas in the long term or the short term. Okay, so a couple of key quick charts in focus, and then we're going to start to get into the numbers as well as far as how the long term and the short term portfolios worked. So investment growth attributed to AI spend, as far as GDP figures, it was most of it. I'm going to kind of highlight here this contribution of AI components in the light blue. That is your highest component to the circa 2.83% GDP figure that we've got. That again is just how critical this is to, you know, so much future basically being banked onto this. The other item that I mentioned, 2025 hyperscaler bond issuance. So this is literally, you can visually see the borrowing that these companies are now going through. And there is somewhat of a risk of a circular reference that's taking place. Last year we saw NVIDIA, who make the chips, very happily willing to invest hundreds of billions into the companies that are going to buy their chips, so much so that I could say, hey Tim, I'm going to invest 100 billion in your company if you turn around and then buy 100 billion worth of my chips. There seems like there's a circular reference that goes on there. That hyperscaler bond issuance already at the end of last year was actually just shy of $120 billion. If we jump on to a little bit of some of the things that's happening today, one of the critical questions I expect would probably get asked is the software sector. You've all kind of seen some of the numbers that's taking place there. Is AI a friend to certain businesses versus others? Because we were operating under the assumption in 2025 that AI was just going to be a productivity enhancer and a cost saver. Our firm just wrapped up our technology, media, telecom, TMT conference out in the Bay Area just actually yesterday. The critical points made was that was last year's thinking, essentially. That, yeah, you're going to get, you know, nice productivity gains and so forth. Everyone's going to work well. But now AI is working so well that there are actually industries that could literally be entirely disrupted and quicker than people thought. Software was one of those. So take a look at the scary chart here, and that's the North American Software Index versus the S&P. Blub, dropped off a cliff, about 20% decline. Adobe is 50% off its high recently. What's happened is you can use Claude, for example, other AI agents to literally, if you were, my 16-year-old son in his bedroom, could go with those AI notes and basically create a software program. So Wall Street's kind of picked up that this is actually a severe worry, and it's pricing the intellectual property of a company like Adobe down to zero. Now, the reality is, what we expect to take place is, if you were a software company that is just using publicly available data and somehow packaging it into your software, that's where there's possibly no value, because AI can very easily do that. So you need some kind of reason for being in software. Now, I don't think PDFs are necessarily going away, and in fact, Adobe would be a company that is embracing AI itself. So yes, Wall Street can get it wrong on these moments, but right now, the most challenging area of the market actually appears to be software. So the landscape has shifted from, oh yeah, AI is everyone's friend. Yes, let's, companies that would announce earnings would say, yep, we've adopted this model and it's going to be great. Now it's, are you going to survive actually because of it? So that's critical to look out for. Let me just jump very quickly to US-based manufacturing. First time in a long time that we've seen this coming back around. So any reading above 50 here is expansion. So we've had great expansion years, post-COVID, 21, 22. We've been in the negative for a while after that, and we're finally just seeing manufacturing kind of coming back to the US. This is a feature, not a bug. When we're talking about how the administration has kind of been leaning on the US dollar to try to, devalue the dollar somewhat, that is with the intent to help US manufacturing so the goods that we make here look relatively cheaper. It's as easy to say a European-based person would see a Ford motor car and say, that looks cheaper than a BMW. Great, I can, I'll transact at that level. So we're seeing manufacturing coming back. The other item that we're seeing too is, this is critical. So remember I mentioned one of the top performing stocks year to date. I didn't check this one yesterday, but there was actually Caterpillar. You're seeing value stocks taking leadership over growth stocks for the first time in a while. And I will actually share another interesting statistic. Do you know how many companies this year, from January to where we are in March, have moved more than 25% or more? In either direction, 25 up or 25 down. How many companies? 1,800. That just goes to show the level of volatility that we're now living through in kind of this sea change environment. That is illustrated there with that growth and value leadership change. And one last item before we get onto some of the portfolios here. I do want to talk as well about the labor market, because even just today we had a negative labor number. I think the economy lost 59,000 jobs, I believe was the figure. 4.4% is the unemployment rate. That's not bad by history, but there's a dangerous zeitgeist going on as well, and that's what's illustrated here at the bottom. The perceived probability of losing a job has gone up. Everyone thinks the layoffs are coming for them. They haven't necessarily been announced. And also, the other flip side to that, expectations of finding a job have gone lower. That is probably a reflection of just the confusion around AI in particular. What is it going to truly do? Companies that just do normal layoff announcements at the beginning of the year, you do see that, by the way, with large companies. They'll just arbitrarily say, hey, we're going to try to get rid of X% of our workforce. And what they actually do is then they end up hiring back some people for other departments. What you want to watch for is during this mode, does the hiring back also take place? So this is weighing on the minds of the consumer. If you're the average American considering buying a big ticket item, if you're worried about losing your job or the prospects of finding another job afterwards, you're probably not going to spend. And remember, our economy is 70% based upon consumption. So we do need that to pick up and continue. Okay, I know one final item, and then I promise we're into the portfolios. This year in particular, we could see some incredible IPOs coming to the market, trillion-dollar levels. We already saw Elon has merged XAI into SpaceX. The perceived whisper number is somewhere between 1.2 to 1.5 trillion as an IPO, possibly in June. That will likely force ChatGPT's hand later on in the year, possibly Anthropic as well. So we could have some of these mega IPOs actually coming out to the market. And that is going to be a welcome respite to a lot of investors that have held those companies for many years and hadn't experienced any liquidity from them. For the public markets, that can create trading froth, and that can create, obviously, if somebody's going to be rushing out to buy the XAI SpaceX when it IPOs, well, in theory, they'll be selling one stock to do that. So look out for that as a moment of market volatility. Okay, so let's just go into the performance side here. So last year, in particular, for the long-term fund, it was a very strong year in terms of absolute performance, gaining approximately 14%. Had we have been able to kind of close our eyes at the beginning of the year and somebody say, would you accept a 14% level rate of return? Yep. I'd take that again if somebody was asking that for this year. But it is interesting, though, that does actually underperform the benchmark that we set out there, which, by the way, the benchmark that we're using is raw global stocks and global bonds. So clearly, what happened with global stocks? We have that concentration issue still. But we do believe that already from what we've seen at the beginning of this year, that is changing and quickly. So we are seeing at the beginning of this year, even with the Iran situation and so forth, would you believe the long term is actually positive about 1.6%? And the short term, I'm going to show you in a moment, is positive 88 basis points. Unaudited figures, as Ken will tell you, but just whisper figures as we're kind of seeing it live. So we're actually seeing a strong benefit from the risk management that is in place with the funds. On the left-hand side here, this would be an incredible eye test for you there in the back. Large cap stocks are 25%, small and mid cap stocks are 5%. That's a weighting and one of the areas that we're actively adjusting within the portfolio this year, because we do think there's going to be a lot more area for opportunity there. Developed markets and emerging markets, 21 and 6% respectively. So we are catching that upside. In particular, this year, by the way, international stocks are up about 10%. That'll adjust obviously with some of the conflict, but it's one of the strongest performing areas. So we're catching that within the long term. This is a staggering fact, and going back to the long-term thinking that we talked earlier, I love our chart in the lower bars here. This is from 2010 all the way to the close of last year. $100 invested in the long-term portfolio would have grown to $300 by this point. So it's a 3x return basically over that time period. That is the biggest message that we can always give in terms of when we're going through volatile markets and so forth. Just time in the market matters more than trying to time the market. Just stay the course with this. We're obviously making with the FIC as well, and looking through underlying investment managers, asset allocation and so forth, basically managing that to a point that we can get to those triple assets over that time period. And just very quickly, I just want to move on to the short-term portfolio here. So short-term portfolio, which obviously is a shorter philanthropic time horizon, it's not all just fixed income based. And in fact, last year it earned an 8.6 rate of return. Very attractive versus obviously what you'd be seeing from banks, CDs, fixed income investments. And that's because we do put a little bit, you see, 8% large cap, 9% international, dividend focused securities as well that can kind of help pick up there too. Very strong year. And also, $100 invested in 2010, $210 as at the end of last year. So certainly both portfolios working exactly as we would intend them to over this time period. And actually last year's returns from an absolute standpoint, we're pretty pleased with those. So I know I'm kind of coming up to the time mark, and I know we need to take a minute to get some questions. Yeah.